everyone. This is Jeff Praisman with Interactive Brokers Podcast. It's my pleasure to welcome back to the podcast studio from Market Chameleon, Dmitry Pargamanik. How are you?
Hey, Jeff. How are you?
Oh, love having you come in here. And for our listeners that don't know, every second Tuesday of the month, Will and Dmitry do a webinar with us, and they come by the podcast studio afterwards to take a different dive into the subject. So what are we going to talk about today? Great webinar, and I'll let you kind of tell our listeners what we're going to do this podcast on.
We're going to talk about option trading activity, option trading volume from the perspective of single leg trades. So when we look at the option trades, you could have single leg trades like buy a call or put, or you could have a multi-leg option trade that's entered in as a spread. You could also have a contingent option trade that's tied to another security, like a stock. But we're going to talk about just focusing on the single leg trades and how we could aggregate those trades or even categorize them to get more meaningful insights and analytics.
Start with a 10,000 foot view. Like, what are option traders actually seeing when they look at the options tape? And are there items that they're just usually misunderstanding?
When we look at just the regular option tape, we get a few raw data in there. We get a time in sales where the exchanges report a transaction, a trade, with the volume, the trade price, the trade condition, the time of the trade. We also have another feed that reflects the bids and offers, or the, market makers' bids and offers, the limit orders that are on the book that get displayed. So that comes from a different feed. And it's important to know that these are separate feeds, but oftentimes we do try to connect them together, tie them together because they're related by timestamps to give more meaningful insights. But the trade tapes themselves are the raw data. And then from that raw data, we start to make inferences, analytics, derived data, and that's all add-on values.
So, Dmitry, from your perspective, what do traders sometimes think the option order flow is telling them versus what it may really be showing about market behavior?
I don't know what everybody out there thinks, but I think a lot of times people turn to order flow as an indication of direction for stock. And that's not always the case. People use options for many different reasons. It could be for volatility, it could even be for carry trades, it could be for different spread type of transactions. So I think that it's important to understand that options themselves are tools that could be used for different purposes, different hedging, different strategies, and it's not necessarily exclusive to directional type of trades.
There's a lot of data out there. This is kind of like a common theme that comes up in a lot of our webinars and podcasts. What are the dangers of an option trader just looking at a single trade or even just a handful of trades, and how can that give them a very misleading picture of the intent?
I guess the intent we never really know because that's not revealed on the trade tape, and the trade tape doesn't let us know who the parties are to the trade. It doesn't reveal this and this person transacted, and we don't know their analytics or positions, so we don't know the intent. But one of the things we were discussing is how to aggregate trades. And sometimes there's more insight if you could aggregate related trades. That could be much more revealing than just looking at a single trade, because some of these trades are not actually just in isolation and unrelated. So aggregating trades is one of the things that we discussed in our webinar, becomes important, especially where you could enter in a trade and it could be for, big lot, but that doesn't mean when it gets executed in one block on a trade tape, it could look like many different trades, that look like individual trades. But if you look at the timestamps and the way it was executed, it was one trade executed against multiple exchanges or limit orders on the book from different parties. So then going back and reconstructing the activity using the available data becomes more insightful of the volume, right? That you could then categorize that volume much better.
Summarize it for our listeners. Like, institution might do a big trade, but it might get broken up for several different reasons into smaller trades, whether different parties or counterparties are doing the trade, or whether they're just trying to get, because of liquidity. And then what you're saying is that you really have to aggregate. It's really one trade, even though it might be 50 different pieces, 50 different orders. And the option trader really needs to kind of make sure they're looking at the full picture with that trade. What signals can help with that? Obviously time, I would assume, price.
Yeah. And you can't get it exactly perfect because we don't know for sure. It's always an inference, and you're looking at it, making the most logical conclusion that, so for example, you're looking at the same option, right? The transactions. And if you're seeing a lot of transactions, let's say I see 1 lot, 5 lot, 10 lot, 20 lot, 30 lot, but they're all within milliseconds, that added up to 1,000, then we could infer, well, this isn't, this is not a typical way order flow comes in. That looks like one trade swept the book, or lifted the limit order book. And even if you go out there and get those limit orders, each one will have its own execution, because you have different counterparties, right? So each transaction with different counterparties gets reported, even though on one side you could have, one party sweeping that entire book. So that's one signal by looking at how it was executed and timestamps. Another is you can potentially observe some repeated activity throughout the day. So certain times even you could see it spaced out, where there was trading, but all of a sudden, like, you see big block spikes going on. And, that could also signal some type of more institutional behavior, that's coming in that looks unusual, and it's scattered throughout the day. So kind of like mixes in with the rest of the volume.
If I kind of understand you correctly, like, the traders really should look at the aggregated order flow, because it may, being a keyword, kind of more closely reflect like the institution's view of the market versus it's not random. In other words, like, it's not random that you have these same strike, same price, or maybe not even same price, but similar time, same strike, same expiration, and so forth. And they might be in pieces, right? But in reality, it might be 1,000 option contracts versus the 75 you're seeing at a time, or whatever.
Right, exactly.
How can they tell, though? I mean, is that really the only way to tell between retail, institution, or professional flow? Is really just trying to, kind of see the overall aggregated volume versus, like, if they see 150 lot, it could be individual's order. But if they see 1050 lots, there's a better chance that it's some sort of professional flow.
Right. And it's not a perfect science. So you do you're trying to analyze and group the data to get, the most logical inference, or the most likely thing that happens, because on the other side, there's no actual indicator on the tape that says, hey, I'm a retailer, hey, I'm an institution. We don't know that on the trade tape for each transaction. So the grouping is what starts. So you could have like one contract that trades in the last minute, and you could make an inference that's probably a retail trade, because institutions kind of don't trade that way. And if they do, okay, maybe they put something out there, but that's not a typical institutional trade. They're managing much larger portfolios and move much larger quantities of funds. And but at the same time, if we see 1,000 contracts trade for $300,000 or $500,000 in notional value, that's not a small retail trader. It's not a typical size. And even if you have a retail trader maybe out there that has that type of a fund, it's almost an institutional size type of trade, because you'd have to be approved. Even if you have the funds to do those types of trades, you have to go through an approval process where your broker would have to establish what you're doing. So even if you came in with $1 million and opened an account and you told your broker, this is the first time I'm trading options, they probably won't let you.
Right.
They're going to restrict your account, even if you have the money, because that's just how the rules
Right.
work.
You got to be
They
level
don't want-
1, level 2, level 3, level 4 certified to do certain
Yeah,
trades.
exactly. So just by looking at the trade size, you already have a good indication that this person's already, like you said, level 3, level 4, whatever it is, it's already a professional person with years of experience, that they could show versus, typical retail trader, even if you're just looking at it by the size of the trade.
And you hear this phrase a lot, right? Follow the smart money. What does that look like how can that be kind of converted for like options data, right? Like, how can someone follow the quote unquote smart money by looking at this data?
Yeah, I think there's some misconception where if you see a large trade, that means it's smart money and you got to piggyback it. But the large trades could have many different purposes for putting it up. A lot of times it could be just hedges, where a large trade goes up because it's a hedge against an existing position. Other times that you could have a large trade that goes up because they're sticking to some kind of a methodology, a strategy that requires, right now, I think we have ETFs out there that utilize options, but they're sticking to a methodology. It's not because they're not buy writing Tesla because they know something. That's the strategy that they're sticking to, right? So it could be a large trade, but it's not because they know something is going to happen or that they know implied volatility is too high or too low. Or this is just a strategy that they're and the methodology that they use. So that exists throughout the market. And, other times people do trades based on their own research, right? So they do have their own research. They trade, it could work out or not, but they do feel that, the probabilities and the markets right now are set up favorably for what their outlook is. So they'll do it. But on the other side, there's a market maker willing to transact, right? So there's another person on the other side who thinks that they're getting edge or they're getting a good deal as well. So I think that the point I want to make is there's a misconception. If you see a large block or big trade go up, then that's smart money. That's an unusual whale. You got to piggyback, but that's not going to work because we don't know the intent, who the other side is or why they're doing it. And there's sides to both transactions. To catch anomalies where there might be a real interesting or meaningful signal usually comes in clusters of anomalies, not just a single one, not just like a single big trade or you usually start seeing different anomalies, different things setting up with divergence in things that you usually happen in sync and in a large volume and divergence in pricing and other things that are going on where then you start looking at it with, wait a minute, there's a lot of things here that are starting to move far away from the baselines. So that would maybe be a much stronger signal than just a single trade.
Got it. Yeah, and kind of going back to what you said, like the right trade for me in my portfolio may be the wrong trade for you, right? Like I might be buying something to hedge my portfolio, which makes perfect sense for me, but makes 0 sense for you that does not have that position that I have.
Exactly. And with options, actually, you could have winners on both sides. It's
Correct.
very possible to have winners on both sides. Somebody buy writes it and the other side buys the option and trades the volatility. And at the end, it made sense for the
Both sides,
volatility trader. Yeah. And it made sense for the person who buy writed. It worked out for both of their positions.
And kind of go back to price, like, does it matter whether the trade occurred at the bid, the ask, or somewhere in the midpoint? Like, does that matter for this data or?
Yeah. So the other interesting thing is when we look at, the trading, the volume, we start stitching related data. And One of them is looking at the liquidity of the market at the time of the trade. So we'd have to go and look at the quotes, that do come in from a different feed, but we could put them in sync through the timestamps. And by comparing it, we see, well, what was the liquidity of the market at the time? Was the spread wide? Was it narrow? Did the trade occur closer to the offers or closer to the bids? Who was the aggressor, I guess, in the execution? And then the surrounding data. So yes, by taking the relative information and then taking the trade and starting to compare and put all those pieces together, it will definitely give you more insight into that trading activity.
And another word that always comes up, volatility, and especially obviously implied volatility, historic volatility, but how should retail traders think about implied volatility when looking at, option order flow? Can it help them kind of avoid some chasing false signals?
Yeah, so the implied volatility, it's very useful and helpful for looking at relative value and the trading behavior, trading activity. So the relative value is, where's the implied volatility right now? Is it high or low relative to history, right? So are we on the high end or low end of the trading range? But we also could use the implied volatility to track the trading behavior. So, for example, we could look at the implied vols for the day, and we could determine, well, the trading activity is centered around this implied vol, right? So this is the fair value. The implied vol is 50, and the trading is bouncing around between 48 and 52, right? So we could say that's how the trading behavior. We could also see if it's trending, right? So if we see the implied volatility moving up, now we're looking at the trading behavior is pushing implied volatility up and the demand is building. The demand for the premium is increasing while the supply is fading, right? We could also see the velocity or the acceleration of it. Is it moving slowly or is it spiking quick? And, and then vice versa on the downside. So the implied volatility, it's important for, many reasons, but the two that we talked about is, first, what is the relative value of this option? Is the premium high or low if we compare it to historical? And how is the trading activity impacting that premium? Because we could observe it through the implied volatility reference prices.
This has been great. Do you have any final words for our listeners?
Yeah, I think that when you start out analyzing markets and understanding and studying markets, it's important to kind of understand the trade tape, the limitations of the trade tape, and the added value that or the derived analytics coming from it, and that jumping to early conclusions is never good, but understanding the trading activity and studying it over time starts to make more sense. So I think that's the key takeaway.
And for our listeners, you can find more from Will and Dmitry every weekday morning on their YouTube show. I believe it's from 9 to 9:30, right, guys?
Yep.
That's Eastern time on our website, IBKR.com, and also at Market Chameleon. Thanks. Always love having you come in here.
Thanks, Jeff.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Options involve risk and are not suitable for all investors. For information on the uses and risks of options, you can obtain a copy of the Options Clearing Corporation Risk disclosure document titled Characteristics and Risks of Standardized Options by going to the following link ibkr.com/OCC. Multiple leg strategies, including spreads, will incur multiple transaction costs.